Namaste to all. Welcome you to this another series of knowledge sharing on accounting standards and Ind AS. And today, the topic which the team has chosen is a very, very interesting and important topic, that is accounting for inventories, which is applicable to nearly, I would say, most of the entities who are dealing into goods and even services, I would say, to a certain extent. To share this topic in a panel discussion, we have got two eminent panelists. One is CA Yagnesh Desaiji. He is our
Namaskar.
senior. Namaskar, sir. Welcome, sir.
Namaskar.
He's a co-opted member of our accounting standard board over the various years, and he has been in practice since past quite a few years, more than nearly now 40 years, I would say.
You said it.
And he has wide knowledge of the audit of corporate and taxation matters, and actively associated with the activities of the institute. He is an IFRS trainer, and for not only the Institute of Chartered Accountants in India, but also IFRS examination diploma course for the he has composed and delivered e-lectures on accounting standards for the Institute of CA, and various seminars all over the, I would say, world, because he has trained many CPAs of Philippines on IFRS. And the beautiful thing has got the numbers of his sessions. Pinpoint today, he would be discussing on his 1129th session today. Great, Yagnesh sir. Today also he was there in the board, and we really acknowledge the contribution which you are making to the fraternity at large.
Thank you, sir.
Another panelist which we today have is, of course, CA Abhinay Gupta, who's again done the certificate course on IFRS in the Ind AS. Welcome, Abhinayji. And he has also delivered various lectures, more than 100 lectures on various platforms, committees, universities, branches, NIRC, CIRC, regional councils, even RBI, final CA students, CAG, and various others on basically Ind AS. Yes, he has done, and he is a regular contributor to our accounting standard board. Really, we thank you, Abhinayji, for joining today to share your views on a very, very important
subject.
And to moderate these two stalwarts, we have got another stalwart, I would say, CA Asta Gupta from Delhi, a young and dynamic chartered accountant who is a good, keen student, I would say, of accounting standard like me. I am also a good, I would not say good, but yeah, trying to be good student of accounting standard. But yes, I've seen her moderating Star Wars, and today another day where she would be moderating these two Star Wars. So over to you, Astaji, on a very, very important subject of accounting for inventories.
Thank you so much, Pramodji. Before we begin today's webinar, I would like to convey my heartfelt thanks to the Accounting Standard Board for giving me this opportunity to moderate a session consisting of such learned panelists. Today's topic is inventory accounting. Inventory management is important for success of any business model, and good inventory management means you're optimizing the utilization of your resources. It has a direct impact on working capital, on your profitability, employee efficiency. So considering all these factors, I think inventory plays a very important role in any business. And hence, for any finance function and accounting professionals, the understanding of accounting and financial reporting of inventory becomes very, very important. So today's webinar will be in a question and answer format, wherein I will be posing pre-drafted questions to our learned panelists, and they'll be answering them. All the attendees are welcome to contribute the questions during the course of the webinar itself, and we will try to take them up after the webinar, depending upon the time schedule. So without any further ado, let's begin with today's webinar. Just a second. Okay, so first we will be covering the basics of inventory. Yagnesh sir, this question is for you.
All right, thank you.
Yeah. So please define inventory. Is it same as stock in trade? And also, is it the concept is same for a company, a proprietorship, or a partnership?
Thank you, Asta. And thank you, Chairman Sir and ASB, for giving this opportunity to be part of this webinar. And Asta, you've been doing a wonderful job. A very important question asked by you is it inventory same as the stock in trade? And this is a very important question because everyone knows what inventory is. And inventory basically are the current assets. They are held for sale in the ordinary course of business. Also in process of production, such as the for such sales, and also in terms of the raw material which are used for the production process. So we can classify them inventories as the raw materials, work in progress, finished goods, and all this. Inventories basically encompass the goods purchase even for the ordinary sale of business also. So in case of trading entities also, the material purchase for the trading is also a inventory. Now, it also, as I mentioned, encompass the finished goods, work in progress, and include the materials, maintenance, supplies, consumables, tools, awaiting the production process. Very important question now, Asta, you asked by is that whether this stock is same as the inventory. So when we use the word stock, the physiology stock, we are in fact referring to the finished goods. Okay, the helping verb for the stock in trade of stock is the finished goods. So that is meant for the sale or maybe inventory. So we can then say, and it's a very good sentence in one of the materials, that all stocks are inventory, but all inventories are not the stock. So I believe I answer your question, Asta. Am I right? You asked this question very specifically. Is it inventory same as the stock in trade or not? Right? Now here I would like to make one mention about the inventories which amount about certain spare parts, which are spare parts of machinery, spare parts which are not dealt with by the Ind AS 2 and AS2. So this is what this. And I think you asked one more question. What is the second question or the third part of this question, Asta?
The last
is it
part
same
of the...
as the company and the proprietor or
yes.
partnership?
Yes,
Okay.
yes. That,
well,
yeah.
I must say that all types of entities, whether it is a company, whether it is a partnership firm, whether it is a LLP or proprietary concern, all of them have the this inventories. So there is it is the same as for the entities. So entities constitution does not per se any difference about whether it is an inventory or stock in trade or not. It all depends on the business model. Like for example, one trading company, it will be only the finished goods. For manufacturing company, it will be all three elements, all the elements like raw materials, tools, finished work in progress, and finished goods. So per se, the constitution does not play any role in A, recognition, B, measurement, C, presentation, and D, disclosure of inventory.
Thank you for such a great start. Yes, sir, you had something.
Very replied, Yagesh sir. But just wanted to add that yes, very rightly said that it is similar for all type of entities and very, very important because in the Mufasal areas, they think that it is something different. It is only for the bigger entities, smaller ones, kuch bhi kar do. I put any amount and all those things, but we have to be very careful. As regarding stock in trade, one has to be very, very careful that when we classify inventories, the inventories classification includes my finished goods, raw material, work in progress, and stock in trade. So stock in trade and inventories are very, very wider term. Stock in trade is purely for traded goods. You cannot interchange that with the finished goods or a raw material. So if it's a traded goods, it has to be stock in trade, both under Ind AS as well as AS2 as well as ICDS. Stock in trade, you can use only for the purpose of trade good. We have seen under FRRB and other items that QRB and other boards, that when in the case of manufacturing item, they write stock in trade, which is not correct. It has to be used only in case there is a trading item. That is stock in trade. I just wanted to add again.
Thank you for the clarification, Pramod.
Thank you.
Yeah. So, okay, we'll go on to the next question. This question is for you, Abhinay sir. Is definition and coverage of inventory different as per accounting standard 2, IND AS2, IAS2, and ICTS?
Yeah. So, people, have been studying AS2 earlier before the Ind AS and IFRS has come into picture. So when in 2017, ICI, decided to converge with the IFRS. So they have come up with the Ind AS. So this is basically the converged version of IFRS. Now, if there is any difference between IAS2, that is the standard of IFRS series, and the Ind AS 2, so there is none as far as inventory definition is concerned, or the coverage of the inventory is concerned. So there is no difference at all. It is a mutandis copy paste definition. There is no carve in or carve out. As far as AS2 and Ind AS2 is concerned, so yes, because both the standards have defined in their own manner the inventory, and there are certain additional clarifications which have been brought in by the Ind AS. Like Ind AS has expressly clarified that intangible assets, if held for trading, can also be classified as inventory. However, there is no such express mention in AS2. So it is more in the nature of clarificatory. So I wouldn't say that is a difference between the two, but yes, technically it can be regarded as a difference, because Ind AS is some way going ahead and expressly clarifying certain additional things. That's the basically answer to your question. As far as ICDS is concerned, so inventory definition is not, expressly provided in ICDS. They are more discussing towards valuation of inventories, which is largely same whatever we have been doing under AS2 as well as under Ind AS2. Although there is a minor difference between ICDS and Ind AS, and that difference is also there between AS and Ind AS, is regarding the finance cost. So Ind AS 2 expressly talks about the finance cost component as well to be excluded from the valuation for the purpose of inventory. And AS2 is silent on that. So, financing element comes into play whenever, we have agreed with the supplier of raw material, additional credit periods, which are beyond the normal credit periods allowed. So if the financing component is involved, then Ind AS 2 specifically asks that we need to break the contract into two parts. First is the purchase of the raw material, and the second is the loan or the financing element which has been involved in the transaction. And we have to, demarcate the financing component and should exclude that from the valuation of inventory. So that's my answer for this.
Okay.
I
Thank
hope
you,
I have been able to, clarify that.
Yes, very much. Continuing with the next question, it is about the valuation of inventory. So from our, college days, we've been reading this, that the valuation of inventory is at cost or market price, whichever is lower. So Abhinay sir, can you elaborate a bit on the same?
So regarding valuation, we all know that there is simple measurement rule, cost or NRV, whichever is lower. We have been learning this since our early days when you started learning accounting, right? So inventory is always valued at cost or NRV, whichever is lower. So be it finished goods, be it work in progress or the raw material. The only difference is the mechanics, for valuing this are different under certain situations. For example, if my finished goods are well sellable above the cost, then I will not, value raw material at NRV, even if NRV cost is lower than NRV. Okay, so that's the difference. But in case of finished goods, I always apply the same rule, cost or NRV, whichever is lower.
Okay, Yagnesh sir, continuing.
No, one thing.
Yes, Pramod sir, please. Yeah.
Here, what is important is that apart from what Abhinay sir has said, most of the people still say cost or market price, whichever is lower. First of all, it is totally incorrect. It is not market price. It is net realizable value that we'll be discussing later on, the difference between the two. Second, it is, though seems to be too technical, but it is lower of cost and net realizable value, not lower of cost or net realizable value. You have to compare between the two. So, and has to be there. So one has to be very clear. Though when we select into the income tax free CD, they say still write cost or market price, whichever is lower. But technically, when you are having your accounting policies and all other things, there it has to be lower of cost and net realizable value. This is a small thing, but important to be mentioned when you are finalizing the financial statements.
And one more thing I would like to add here, because you have brought up this matter. So India 2 specifically talks about that measurement rule doesn't apply in case of brokers and traders who are explicitly trading in the stocks or commodities on their own or on their client's behalf. So in that case, disclosure rules of India 2 still apply, but measurement rules, that is cost and NRV, whichever is lower, doesn't apply. In that case, fair value less cost to sell would be used.
Okay. Yeah. Thank you for the clarification, Pramod sir, and thank you for this additional piece of information. Yagnesh sir, let's dig a little deeper into this concept. Can you explain the concept of cost and NRV?
Before that, I must appreciate, Chairman sir, you are a man of detail. Yes. You are a man of detail. And I really appreciate that you have pointed out that cost or market value, instead of that, the correct physiology should be not or, but and. I really appreciate that. Well, but before that, Asta, I wanted to say something about my first question about the inventory.
Sure.
And this is an exception to the rule of Ind AS 105. Ind AS 105 deals with the non-current asset held for sale and discontinued operation. Now, if an entity is into the business of hiring the laptops, computers, or any of the assets, vehicle, aircraft, etc., if they are in the hiring business, so they normally give on hire this equipment, laptops, computer, etc., whatever it may be. And due to technological obstacles, they routinely take out these laptops or the hired item from the hiring business and transfer this to the inventory. In that case, the paragraph 68A of Ind AS 16, I repeat, paragraph 68A of Ind AS 16 makes it very clear that in that case, entity when transfer this so-called non-current assets into the inventory at cost, they are, in that case, Ind AS 105 will not be applicable. Not only that, it goes one step further, that when entities sell this inventory, the amount realized will be recognized as the revenue and not a gain. This is an exception to the rule of IFRS 105, and so much so the standard 68 paragraph 68A of Ind AS 16 makes it very explicitly clear that in such cases, Ind AS 105 will not be applicable. So that is also an exception, and those who really want to delve deep into the IFRS should go for that. Now, Asta, aapka prashn tha, how inventory is measured. Okay, as sir and everyone has said, even Abhinay also said that they are measured. The measurement criteria is the valued at lower of cost and the net realizable value. Now, some people mistaken net realizable value as a fair value. That's not the case, because fair value is not an entity specific, whereas the net realizable value is the entity specific value. Now, first we'll see that we'll look at the first lane, that is the cost, and then we'll talk about the NRV. Then as far as the cost is concerned, it is naturally all the purchase cost, then the cost of conversion and the other costs. So these costs can broadly be divided into the three costs: A, purchase; B, cost of conversion; and 3, the other cost. Now let's come to the cost of purchase. So cost of purchase is raw material, include the duties and taxes. Now when it comes to the taxes, say the most common example of tax is the GST. All right. Now GST, the GST reminds us the input credit and output credit, right? So the amount which is adjustable or recoverable and which is known as the input credit. So the purchase price should be net of input credit. Here ICDS differs, and ICDS say that the as far as purchase price is concerned, it should be inclusive of tax. I think there is one question: inclusive approach and exclusive approach. Am I right, Asta? So it will be covered.
Yes, it's there. Yeah.
For the moment, yeah, I think I must mention here that any tax which is not refundable, Okay, that is, it is also known as the non-refundable tax. They say the tax which is subsequently not recoverable, other than those which is subsequently not recovered. That's the phraseology I think it is used in the standard. So suppose if I pay the GST of 18 and I get the refund of 8, the only 810 should be added to the inventory cost, not otherwise. Well, this is a requirement of the Ind AS and AS2. However, as I told you, ICDS differs here, and they say that it should be including 18. Then comes the cost of conversion, which includes the direct labor cost, then the cost of materials and direct overheads and all this. And thereafter, there is the allocation of the variable overheads. Fixed overhead and variable overheads are to be allocated to this. Now, in this case, we have to be very careful about which overheads. We have to be very careful about the normal production and the abnormal production. Correct? So, in case these overheads are allocated basis the normal production capacities. In case of abnormal production capacities, one should not be allocating such cost to the inventory. Should I give a small example? छोटा सा example दे दो.
Yes, please. Yes, please.
ये रहा example आपके लिए. Now suppose my normal overhead allocation is say 5 rupees per unit. Normal overhead allocation. But abnormal production and that too lower production. Instead of 1 lakh units, my production is 50,000 units. Bilkul आधा. So my overhead per unit will go up. जो पहले 5 रुपया था 10 रुपया हो गया. Yes or no? Hello? Correct? Are you getting? Fine. Asta say yes.
Yes,
Okay?
yes. I'm sorry.
Yeah.
There was some problem. I could not answer. Yeah.
Anyway. All right. Now, when I add 10 rupees to the inventory, this is going to be my closing inventory. Correct? By 5 rupees, which is an extra overhead. Correct? My valuation of inventory will go up.
Right.
Now, what is the impact of the increase in the value of the inventory? My profit will go up.
Right.
Correct? Is it digestible? No.
It won't be.
That's the logic behind it. Okay, when it is an abnormal production and that too lower, abnormal production could be higher and lower both. Correct?
Right.
But when the abnormal production is lower, then be careful not to capitalize the overheads. Correct? But rather, अब प्रश्न ये है अगर ओवरहेड कैपिटलाइज नहीं करें तो क्या करेंगे? क्या हम डिफर करें या एक्सपेंस आउट करें? The correct accounting treatment is, in such cases, the abnormal overhead which has not been allocated to the inventory should be expensed out in the income statement. Okay, sir? All right. Now, the other cost is, which normally the standard use the word, any cost which is directly attributable to bring the asset in the present condition as decided by the management, which includes the transportation cost, any overheads, transportation cost, any duties, octroi, etc. will be capitalized. अब बात आती है interest capitalize करे या ना करे. So there, Ind AS 2 has to travel to Ind AS 23, borrowing cost. And there, if it falls into the definition of the qualifying asset, like, for example, longer time, then the subject to the conditions of Ind AS 23, interest cost may be capitalized. Example, for Boeing company, aircraft company, inventory is aircraft. For Mazgaon Dock Limited, submarine is an inventory. Now, each submarine normally takes 5 to 6 years' time. And you'll be surprised, Asta, to know that the first submarines normally take 8 to 9 years.
The reduced time.
And later, prototype takes a longer time, and then it takes 5 to 6 years' time. Now, it's an inventory, correct? It's taking a substantially longer time. And that's the definition of the qualifying asset. So in that case, interest cost is to be capitalized. Okay. Right, sir? Okay. So but then the question arises, which type of costs are not capitalized? The first I mentioned was the abnormal overheads, then the storage cost, Administrative overheads and the selling and distribution costs are not capitalized. Storage costs are capitalized in some case. And that is if I have given my product on consignment to others.
Okay.
If I have given my products if I made a sale on consignment basis, if I have made my sale on the consignment basis, only in that case, even the storage cost is capitalized, not otherwise. All right. Now, अब आप बताइए कि आपका प्रश्न होगा कि सर बताइए NRV क्या है?
Right.
Net realizable value. Now, they say that, and I had mentioned to you that it should not be mistaken for the fair value, because fair value is totally different. We talk of the net. As the word indicates, whatever you realize, net, the prefix net is very important. So what do you mean by realization? So that is say that estimated selling price is first you are starting with the estimated selling price, and that too in ordinary course of business, less the estimated cost of completion. And again, if Chairman Sabi will say, sir, you use the word and, not or, okay? And estimated cost necessary to make the sale. So this is the NRV. All right. Now, I also think of disclosures. That when you measure it lower of cost and the NRV, right? So actually you should create the allowance account. Effectively, you should create the allowance account. First, the cost is 1 lakh and the NRV is 90,000. So I am creating an allowance of this write down to the tune of 10,000.
10,000, right.
The presentation will be inventory minus allowance to outer column will be 90,000. Why am I asking about write down and all this? Creating a allowance account in your books of accounts. There is some reason.
Okay.
Because write back, reversal of write down is permissible in Ind AS. So you should have a control account of the allowance for the write down of the inventory. So I remember at which point of time how much I have written down the inventory to. Because my reversal cannot be more than what I have written down. Of course, there are some conditions apply. Okay. But by and large, one should read the allowance account.
Okay.
All right.
So thank you for such an elaborate explanation of cost and NRV. We will continue with the cost arm of the question. Could you elaborate?
As far as ICDS is concerned, it is including the cost of services.
Just allow me a second. Please continue, sir.
ICDS talk about the cost of services also.
Okay. Yeah, Abhinay, sir, you had something to add?
And as far as the interest and borrowing cost is concerned, that from the ICDS perspective will not be included in the inventory.
Okay, great. Yes, sir, Abhinay, sir. Please tell me.
So, Yagnesh sir, you have explained very nicely both the concept cost and NRV. I really appreciate. And just I want to add one more thing regarding the storage cost, where you have given an example as well. But I am just discussing one more situation where the storage cost can be capitalized. So those stocks which takes time to manufacture, they get produced by the passage of time, like wines. So in that case, storage cost can be capitalized or should be capitalized. So that is another situation where storage costs are allowed to be capitalized.
I'm sending this material from. Sorry to interrupt. There's a very good example. Wine is an example in the book also, and that's correct. But see, more than storage, they call it a process. Sometimes, if you look at the US GAAP, argue that it should not be, though it is the fact that it is storage should not be mean it is a storage cost. So this was the argument in the US GAAP. But fine, I appreciate. But one more give example. I mean, आपने मुझे सुराग दिया कि कुछ एक और भी एग्जांपल दीजिए, ओके? देता हूँ यहाँ पे एग्जांपल और ये सिर्फ ये बैच के लिए. Suppose I have a factory number 1 and factory number 2. So factory number 1 to 2, I'm sending goods from premises factory number A to B for processing. And again, in the meanwhile, if I'm storaging this, so anything and everything which is the storage cost should not be treated blindfoldedly. You get the point? केवल
Right.
स्टोरेज के इसके कि इंक्लूड एक्सक्लूड नहीं किया जाए, समझे ना? तो इट because from one factory number 1 to 2 it requires to be processed by factory number 2, then it becomes a finished goods, है ना?
Right.
तो केवल स्टोरेज कॉस्ट से आप मत होइए and don't get eclipsed by this word storage cost only.
Yeah.
Right.
You have to delve deep into the matter. Okay, कहीं में
Right.
समय नहीं जा रहा, माफ कीजिएगा.
No, not at all, not at all. Thank you for this clarification. So continuing with the same discussion, let's go a little deeper on the cost aspects. So Yagnesh sir, what are the different methods of measuring cost of inventory?
Okay, सही बात है. Their methods are first is the normally first in first out. Second is the weighted average method, and this also known as the moving average method. Also, there's a and then the last in last out. Last in first out. Sorry, in fact, that method is not permitted either by AS2 and in this 2 US GAAP permits that. Yeah. So inventories, as I mentioned, LIFO method is not applicable. I mean, it's not permissible.
Is there any specific reason why LIFO method is not permissible in comparison to FIFO, moving average or weighted average?
चलिए रुक करते हैं. What is LIFO? Last in, first out. Correct?
Right.
Last in. I made some purchase in 2010. The last purchase is in 2022.
Okay.
So last in, first out. That means whatever I purchased in 22 will be removed
first.
Okay, first. So I am still sitting on the cost of the what I purchased in 2010. And during the inflationary pressure, do you think is it going to be sahi mat?
No.
I give a very wild example though.
Okay.
दायका का example दे दिया मैंने. Correct.
Okay.
But in other words, that's not the representative cost. That's why.
Okay. So coming back to the question again, can you elaborate a little on the different methods, FIFO, moving average, just as the definition bit so that our attendees get to know about it?
All right. So as the name indicates, the first in, first out, if the items are identified, and because that is applicable only when you can identify the item, so then what I purchase first will be first taken out of the inventory. And then, so in that case, the item which I purchase to the later part of the year will comprise the inventory.
Right.
And that cost will be, and these are not averaged out. These are not averaged out. These are specifically per unit cost. As far as weighted average is concerned, then at every stage you are taking the average. चाहे वो purchase हो या चाहे withdrawing from out of the window entity, you keep on taking the average. So that is the, as the name average, weighted average cost, or maybe the moving average method.
Okay. Abhinay sir, this next question is for you. So like Yagnesh sir has explained the cost concept, can you explain the different methods of measuring the net realizable value?
Sorry, Asta, can you please repeat the question?
Yeah. So my question is basically, how does an entity measure the inventory at NRV? And can it be valued only at NRV and compared with cost?
Yeah, so net realizable value, as the name suggests, it is what the entity is going to finally realize, right? And that has to be netted off with the expenses, in order to realize that. So if the realization price, which is fetching, is say rupees 10 per unit, and 1 rupee is the commission, brokerage, or whatever other charges which are being incurred only because you are entering into this transaction. So that has to be netted off, and the net price realized is the naturalizable value, basically. In cases of dissolution of the company, only net realizable value is to be measured as a measurement basis for valuing the inventory. In that case, cost is disregarded because the focus shifted to, realize all the assets of that entity. And that's why, in that specific case, NRV is the basis which should be used. And that is also, clarified in one of the ESE by the ICI.
Okay. And can it be value? Do I need to compare it with cost also? Or
No, in that case, you don't need to compare it. Yeah.
Okay.
There is no
Moving on.
lower or high. It is simply straight way the NRV.
Okay, got it.
Even in case of scrap, just adding. Even in the case of scrap,
is the requirement of the ICDS also, right?
Yeah. Hello, am I audible? Yeah.
I think Pramodji was saying something.
Yeah, Pramod sir, about scrap, you were mentioning something.
Yeah, I'm just saying that in the case of scrap, it can be valued at NRV.
Correct. That's correct. Yeah.
Okay.
And actually, what happens? Mainly in the case of, I've seen food grain traders or vegetable traders or fruits traders. They value their inventory at market price, which is incorrect. Which is incorrect. They have to do at cost and net value.
Okay.
Just sharing because
प्रमोद जी आपने बिल्कुल सही बयान किया प्रमोद जी आपने बिल्कुल सही किया people are over influenced by the word market value, you know.
Right.
बिल्कुल सही बताया कि normally people say I mean cost lower of cost and वो भी आपकी भाषा में बोलूँ तो गलत इंग्लिश यूज करते हैं lower of cost और market value दो गलतियां करते हैं. So very good observation, Chairman sir.
Okay. And Yagnesh, so you were mentioning something about the ICDS. I think this disclosure is required in ICDS.
That also, I mean, since Abhinay has said about the dissolution of the entities, so their ICDS also overriding some of the judgments has said that the inventory has to be measured at NRV.
Yes.
Okay. Thank you for that bit. Abhinay sir, next question is also for you.
कुछ और भी दिलचस्प बातें बताऊंगा because there is one question earmarked for me.
Okay, yeah. So Abhinay sir, continuing with this question, can the inventory be valued at GP rates or retail method?
Yeah, so retail method is another method which is being widely used by those entities who are having multiple products. So when there are number of products the company is dealing with, so they can go for the retail method like departmental stores. They are handling all types of daily need items. So in that case, retail method is very well applicable and used by those companies. Now in that case, what happens? Entities just calculate the cost by eliminating the margins they have put them on. So MRP minus the margin is what the cost is computed. Now the important point here, we need to note and always keep in mind while doing this exercise. In many cases, departments and these stores, put up some discounts like 10% off, 20% off, 30% off on certain categories of items. Now, while arriving at the cost by eliminating the margin, we have to consider those discounts as well, because those discounts are already marking down the prices by certain threshold. And if we straight away apply the margin on those markdown prices, then we will come up with the wrong cost calculation. So we have to mark up those discounts first and then apply this markdown basically in order to calculate the cost on that case. So that is the one of the thing which should be kept in mind while doing this working for the department and stores.
Got it.
No. One thing important out there.
Yes.
Very important here. What Abhinay sir has said is very, very important. But what is happening is that many of the industry, they are into manufacturing or trading of goods and not retail store. Still using that retail method, which is as per standards, not allowed, not correct. So I'll request them to please take care that retail method can be used only in the case of retail business, like Abhinay sir has said. So kindly take accordingly, otherwise they should say that accounting standard has not been complied with.
Correct.
In retail business, they are interchangeable goods. That's the phraseology used by the standard for the retail method.
Okay.
Yeah, and the retail store, as sir has said correctly.
Right. So, Yagnesh sir, you had mentioned about the inclusive and exclusive method in the previous queries. We've come to that question now. So, please explain the inclusive and exclusive method of inventory accounting.
All right. Now, the word inclusive, the dictionary meaning is included. Correct? And
Yes.
the word exclusive means excluded. Now, the question arises, what is included and what is excluded? So
Right.
there they are referring to the including the taxes and duties, which is recoverable. Correct? Which is recoverable. That is known as an inclusive method. As I mentioned, give the example for that. That, for example, I paid 18 rupees GST. And if so, the entire 18 rupees will be covered in this cost, and that's not the inclusive. So, including all the taxes, regardless of whether they are refundable or not, they are adjustable or not, whether you get the ITC credits or not, they are included in the cost of the inventory. Excluded means the same concept in the property, plant, equipment, intangible asset, that whatever non-refundable taxes are there, only those you need to capitalize or add to the cost, not otherwise. Because actually, if you go to see the input credit or the refundable taxes are actually an offset against your future tax liabilities. So this is basically known as the inclusive and exclusive method.
Okay. So, does the organization have a choice to choose the inclusive exclusive method, or the standards define them? And also, what is the variation between AS2, Ind AS2, IAS2, and
As far as
ICDS
AS2
regarding?
and Ind AS2 is concerned, they are following the exclusive method. There is no question of choice because the standard says that. Okay, when it comes to the ICDS, वो अलग भाषा बोलती है. ICDS कहती है कि it should be inclusive approach.
Okay.
But Pramodji, what is your experience about this inclusive and exclusive method between the ICDS and all this? Because this actually, in my point of view, will give rise to the deferred tax asset.
I
have not seen any company accounting for inclusive and exclusive difference in the deferred tax table, sir. Calculation of deferred tax.
No, if we see, this arose because of our income tax under Section 145A.
145, absolutely.
What happened that AS says it has to be exclusive method. And the moment actually it was when the excise duty was there. At that time they said that, okay, certain income tax judgment which says that it has to be inclusive of all taxes. So at that time the institute brought a guidance note on that. And they made all those calculations for the purpose of income tax, including 3CD, the relevant clause. And they made a full chart, which in the old guidance note, it was at para 25.1 something there. They said that, okay, you include in purchase, you include in sales, you include in closing and opening, and the difference you pay by 43B. And at the end, they said that, okay, there is actually no impact on profits. So what is happening since then, that the entities have to account for at exclusive method only. If they go for inclusive method, then in that case, auditors will have to qualify. They have no option. But for the purpose of calculation, just show that in the income tax. So there would be no tax impact because they say the tax impact is nil.
Okay. Okay, Yagnesh sir, continuing with the previous question, can you specify specific exclusions from the definition of inventory? And also, can you tell us if there is, such situations where there is absolutely no requirement to apply the accounting standard on inventory?
All right, exclusion means you mean to say scoped out?
Yes.
All right. So we were to say what is scoped out, what is not included in the definition of
inventory. Yes.
Because any standards, when they start, they always have a second or third paragraph. They say these standards do not apply to. Right? So that's what you are referring to. So let's start with the AS2 first. Okay. So now AS2 say the working progress arising from the construction contract and including the service type of contract. Then working progress arising in the course of the business of service providers. Then the shares, debentures, which are known as a financial assets, or the financial instrument held as a stock in trade. Now there's a difference between not each and out of the, I mean, of course, basically, if you're dealing in the shares, you will say that this is my commodity, this is my inventory. So don't apply, even if it is an inventory stock in trade for you. Then the producers' inventory of the livestock, agriculture, forest produce, mineral oils, and all kind of things are not covered by the AS2. However, in this 2 is concerned, the scope is reduced. We have seen at least 3 to 4 items in the AS2, which is totally excluded. When it comes to AS2, it said the financial instruments are not covered by Ind AS 2. Ind AS 2 also talk about the biological assets like the living animals, plants related to the agriculture activities as defined in Ind AS 41 and agricultural produce at the time of harvest. Okay, so these are exclusion from the perspective of Ind AS 2. I know now you'll ask me the question, sir, ICDs ka kya funda hai? Right, sir? So as far as ICDs is concerned, it is virtually same as per the AS2, which I repeat, work in progress under the construction contract, including directly related service contract, which is dealt with by ICDs. I think it is 3 construction contract. ICDs 3 construction contract, work in progress, which is dealt with by other ICDs. Then the shares and debentures and the financial instrument held as a stock in trade, which is again dealt with by ICDs 8. If I'm not mistaken, it is ICDs 8. Then inventories of livestock, agricultural produce, forest products, mineral ores, and all kind of thing. And then one more thing they've added, and that is machinery spare parts. Now, which type of spare parts? Which can be used only in connection with the tangible assets, and their use is not so regular. And then again, it is covered by the ICDS, I think 5, which deals with the tangible assets. Okay. So these are the items which are explicitly excluded from there, and this is in the exclusion scope out. We call it something called scope down. At one point in time, Abhinay has mentioned very clearly that as far as brokers are concerned,
right,
they are excluded, but for a limited purpose of the measurement. Sometimes the standards excludes absolutely totally lot stock and barrel, and sometimes they say that this exclusion is limited purposes,
conditional,
and that is that only for the measurement purposes this standard is not applicable to the mentioned by Abhinay. Rest all others they are applied.
Okay, thank you.
Just one point I would like to add here.
Yeah, please.
So, agriculture produce till it is not harvested is covered by Ind AS 41, and if it is harvested, then it falls under the bucket of Ind AS 2. So, at the point of harvest, it has to be measured at fair value less cost to sell under Ind AS 41, and once it is harvested, it will
then automatically it becomes your raw material. It's your trading item.
After taking the fair value less cost to sell as an initial measurement under Ind AS 2.
Okay.
And then subsequent measurement all covered.
Yes.
Okay. Thank you for this elaboration. Abhinay sir, next question is for you. Please explain the concept of work in progress addressed under the accounting for inventory. And please address this query from the perspective of service providers as well.
Yeah. So, when it comes to measurement of work in progress, so work in progress constitutes, raw material which we have used till now at whatever stage WIPs, and all the labor costs, all the direct costs or incidental costs which are forming part of that WIP. So WIP is measured basis on all accumulation of these costs till the stage they are in at the point of measurement. Now, from the standpoint of service provider, since there is no physical inventory as such involved, service provider are generally delivering the services by consuming the man hours or some other technical work which they might have been performing in order to deliver that service. So, for example, somebody is doing some technical research, and once the technical research is ready, they will be delivering that paper or the formula to the buyer. So in that case, all that accumulation of those labor costs or the technical or the expenses, which they have incurred in doing those research works or services will form part of that inventory or WIP for, service provider.
Okay, thank you. Jagnesh, would you like to add something here?
No, fine. Perfect.
Okay. So next question is for you, Yagnesh sir.
Oh,
What is the accounting treatment of machinery spare and spare parts under inventory?
I already covered here, but still, this is a specific question,
Yes.
so I will cover it exclusively. As far as H2 is concerned, it says that inventories do not include the spare part which can be used exclusively for a particular type of machine. That is, as I mentioned. Now, here they are mentioning H2 revised. H2 has been revised and is broadly in line with the Index 16. Index 16 property plant equipment.
Mm-hmm.
Okay, so there is say that which means the definition of the property plant equipment and as per the AS 10. So basically, it says that AS 10. It says that if there are two items, if an item can be used exclusively for an equipment, or if it is a material. If it is exclusively used only with a particular kind of equipment, or if it is a material item, then it is to be treated as a part of the property plan and equipment, including standby equipment. Provided they are ready to use, not put to use. Provided they are ready to use and not put to use. So those items are specifically covered by the AS 10 because now, as I mentioned earlier, the AS 10 has been revised and is at par in this. In this 16. So as a result of that, they are not covered by the AS2. When it comes to Index 2, Index 2 does not specifically deal with the accounting of machinery, spare parts, and the servicing parts, which has been dealt by the Index 16. But spares and tools are that when we talk of these spare parts, it also reminds me of the tools. Now, tools which are and for that, I think even Index 16 also mentioned the tools which are being used in a regularly for the repairs and maintenance of the equipment are not to be capitalized, but rather they are to be expended out, and then they form expended out when they are being used. Till such time they are not used, they are treated as a part of the inventory. And same is the case with the ICDs. ICD is also referring to the various ICDs which are dealing with the machinery and spare parts.
Okay. Thank you for
yes,
Pramod.
I would like to add.
Yeah.
Yes,
Abhinay,
please go ahead, Pramod.
Okay.
Oh, okay. Thank you, sir. So I was just trying to add. So spare parts, have a life. So if spare parts are having life less than 12 months or less than operating cycle, then those mandatorily have to be kept, classified under inventory. And if they are having life of more than 1 year, and they can be, giving the future economic benefits to the entity for more than 1 year, then they are to be capitalized under India 16.
Okay. Yes, Pramod sir.
Very rightly, I was just wanted to put that only.
Okay.
That if it is having a useful life, if it is meeting the criteria of definition of PPE, then those spares have to be treated as PPE, not as an inventory.
Correct.
However, ICDS, it is that old AS1, not the revised AS1, is that in case those spares are used and in that machinery which enhances this capacity, then only it would be a part of PP. Otherwise, it would be. So there is a difference in the case of spares and stores as per ICDS and AS and Ind AS. So that is a bit confusion. The one has
but again, you say AS means old AS, not the new one. Old AS
not the new one.
6 and 10.
Because ICDS is created out of old AS.
It's not been updated.
It is from the tangible asset standard, not the PPE standard.
PPE standard. Okay.
So that is the issue.
Okay. Thank you for making this distinction. Abhinay sir, the next question is for you. In a situation of fire, loss, or theft, how is the inventory valued and accounted for?
So ask the very basic question. If there is fire, there is no stock, what the valuation we are going to do in this case?
No, but let's say if it is partially burnt, if there's like partially damaged, how do you go about it? I'm just giving
coming to that. I'm coming to that. So if there is a fire, there is any loss to inventory, or if inventory is stolen or theft. Now these incidents needs to be carefully analyzed. So if this incident or event has happened before the balance sheet date, then of course the question arises: what is left needs to be valued only. What is gone already. Correct. If the event or incident has happened after the balance sheet date, but before the approval of the financial statements. So as per India's stand, events occurring after the balance sheet date needs to be considered in this case. And, nobody can expect that fire is going to happen or, theft has, going to happen after the balance sheet date. So there are no indicators of these events happening subsequent to the balance sheet date. So hence, adjustment is not required in that case. But disclosure comes into play if this is significant or material misstatement if the disclosure is not given to the users of the financial statements. So as per India's 10, this situation is covered. Now, coming to that, most of the companies, get the insurance policy against their stock. So if there is a fire, there is a, theft or any kind of loss is happening to the inventory, so the claims are filed with the insurance company. Then survey happens and it takes usually some time. So probably it might be possible that balance sheet date is falling, in between this process. Now, if the claim has already been approved before the balance sheet date or even settled, then if settled, nothing is to do. So cash has already been received.
Right.
If the claim is approved, but is not yet settled till the balance sheet date. So we have to, understand what are the probabilities of getting this settlement basis on, communication or correspondences happening with the insurance company. Are they willing to pass the claim, or they are, filing some rejections or queries, which management believes that this was the fault of the management, and there are lesser chances of getting the insurance, cleared. So basis on those assessments only, we have to, record the recoverable. So if it is certain to that claim would be recovered from the insurance company, then recoverable has to be recorded in the books. But if it is not certain, then probably a disclosure is required, and when it becomes certain, then only recoverable can be recorded. So that's the answer.
Okay, that's great. I mean, it's good. It's very unique that AS4 comes into play here, and also we need to look at the insurance aspect. So I liked how you use different scenarios to explain this answer. So thank you.
Yagnesh wants to add into this something?
Yes, please, sir.
I just would say that I think what he referred to about the receivable or the claims, it's not probable, then it would tend to amount to contingent asset. Now, in that case, on a basis of the concept of prudence, one should not recognize, but one should add to it. And the fire which has taken place after the end of the reporting period, as per India's 10, but before the accounts are approved, it's a non-existing event.
Right.
In that case, one is to just make the disclosure of that thing.
Correct.
Yeah. Another important point here, sir, which the industry faces is how to actually account for that in the financial statements and books of accounts. The stocks have been lost, say suppose there was a fire. Now the inventory would be reduced. So in the stock register, say X item, 1 lakh ton or whatever it may be, 1 lakh kilo or whatever is reduced. In the financial statements, nothing is visible. One way is that. Second is they want that the loss on theft or loss of stocks on fire, that should be reflected in profit loss. So which way is a prudent way? Because everyone wants, the insurance company wants, the management wants that, okay, what should be the correct way? Should there be an entry reflecting in the books of accounts and statement of profit loss on theft of stock or loss on fire of stock one side, and corresponding entry on another side, and the reduction of the stock? Of course, that would be there. In case there is an insurance, then it is very clear that, okay, loss on fire would be there, and corresponding, suppose there is an under insurance or whatever it may be, taking a clue from what the insurance surveyor is saying or my consultant is saying, to that extent, on a conservative way, I'll recognize that income to be received. But what should be the exact way? Should there be an entry for the loss of my stocks? in the financial statement. Stock register is, of course, it has to be there is an option. Only financial entries.
Sir, what you say is absolutely right. There has
Yes.
to be some entry which should indicate and make it very clear that there was a loss because of the fire. And that's the most desirable way of presentation, sir. I agree with you that anyone, the reader of the financial statement, would like to know that how much is the loss on account of the fire.
I think it brings transparency to financial reporting also with this kind of disclosure. So for stakeholders also, it becomes easier to understand.
How about this entry, sir? Loss on account of the fire account debit to inventory.
Could be.
There is no ledger account of inventory, no?
But then basically is a reduction from the inventory, basically, what I mean to say. Like, for example, when I'm selling goods, when I'm selling goods, I'm passing an entry that cost of goods sold account debit to inventory, like that.
Yeah. That would be cost of goods sold, right?
Yeah.
There.
This entries are given. I mean, in case of provision for the refund and all kind of thing, there are a very good example in Ind AS 115. There's something called the right to receive a receipt and the contract liability. So yes, I have a cue from that loss of fire account. So that, as Chairman Sir has said, the reader would like to know that, and it's a correct presentation. It's a faithful presentation.
Right. So, okay, thank you, Yagnesh sir, for this clarification. I think it will bring a lot of transparency to the financial reporting as well. Yagnesh sir, let's go forward. And the next question is for you. How is the slow-moving and obsolete inventory determined, and how it is to be valued at year-end?
Asta, this question has taken a lot of toll of my time. Honestly, इस बात का इजहार करता हूँ, इकरार करता हूँ. This is my 40th year of post qualification experience. But खैर मुझे तो कुछ loss नहीं करना था. But then I was really trying to see that this is not specifically and explicitly covered in standard. But at the same time, we should not get an excuse that this was not covered in the standard, so I'm not replying. तो फिर भी मैं आंसर देने पे तुला हुआ हूँ. It's my commitment. Now let us take the second part, which is more easy. Absolute part. Asset basically is something which is to be controlled by an entity. That's first thing, and from which some benefit should accrue to the entity. Correct. Now it is an obsolete and dead inventory. The word used by you is dead inventory. Am I getting something from them?
No.
Correct. So we should not simply go by the AS2 standard, but to my knowledge, and I'll also think opinion of the Chairman Pramodji, that in my opinion, anything which is having no economic value, like for example, property, plant and equipment, if it has no economic value, if it cannot be used, correct, and it needs to be discarded. So I took same logic from that. For the second part, which is much easier because you use the word obsolete or dead inventory. So, मेरे ख्याल से this inventory should be written off. Okay, because it's of no use, and there's no point. अच्छा एक बात है, unfortunately, Ind AS 36 is not applicable to the stock inventory, impairment, है ना? नहीं तो I would have gone to the Ind AS 36 और वहां पे जाके बोलता भाई मेरा इसका impairment कर दे, बराबर. But I think the concept of prudence says, nonetheless, the fact that it is not covered by Ind AS 36 does not beat the concept of prudence. And concept of prudence says the asset should not be carried at more than whatever value is going to realize. Chairman sir, अगर मैं गलत हूं तो प्लीज मुझे बताइए सर. तो concept of prudence के तहत मैं समझता हूं कि उसे write off किया जाए.
ठीक है.
Alright. फिर हम देखेंगे हमारे हेड honchos, हमारे चेयरमैन साहब की राय, उनकी मन की बात जानने के बाद में. But now let us come to this slow moving item. अब slow moving item में I have seen and I visited and I asked my team to visit even US Gap also. यहाँ भी कोई जिक्र नहीं है. But एक बात बताऊं, कहीं पे one of the standards they say that, I don't know Japanese or US, but it's a slow moving का definition दिया था, not moving for more than 6 months time. and obsolete item may not moving since last more than 1 year, more than 12 months time. I'm not going to go for the definition, but in my opinion, slow moving item, uh, uh, you should see that whether it's depends on the market value, because if it is market value lower or NRV, then we'll apply that rule. But I think that slow moving item, nonetheless being slow, but still it is an inventory, and it is nothing like the one which you've given the second category, obsolete and the dead inventory. Iske tulna mein, it is still an inventory, and in my opinion, I may be wrong. You never know, sir. So it should be valued at the same principle as lower of the cost and the NRV.
Okay.
Sir,
How
आपकी
about
मन की- sir, आपकी मन की बात-
Sir Pramod, sir, please, if you have anything to add to this.
And I agree with you, sir. Now, when we talk about whole of the financial statements, the basic thing is whatever the assets and liabilities are stated, they should be stated at the amount at which they are realizable or payable. That is one of the basic things in which the auditor is to report about according to that. My AS also says, my auditing report, one of the basic thing is that they are stated at those values. Now, in the case of, very rightly said, in the case of obsolete item, I've seen somewhere persons making provisions on inventories, provisions for inventories. So there is a system, the person is making provisions for obsolete inventories based upon mark to market or at the realizable value or what is there. But yes, of course, when it is an obsolete and it is not to be used, then it should be valued at scrap value. It may be. I'm just putting that question out here, I would say. Because it is obsolete, it won't be able, you won't, the entity won't be able to sell it. तो उसके हिसाब से it has to be at the scrap value when it is sold as a scrap. And of course, slow moving, only a provisioning can be done to an extent to say that it may become obsolete very soon. So
Right. So can non-moving be a third category, or it will be covered under the umbrella of obsolete only? A non-moving stock, like which has not been moving at all due to other factors or anything.
Of course, it has to be again valued at the net realizable value, because that would be very lower, because it is not moving. Not moving. Because what is happening that we have seen the problem which arises in the case of such loans where the stocks are still kept to be valued at cost. Right. And they see that, okay, whenever it would be sold, it would be still, the NRV would be higher. But when we are finalizing the financial statements, we have to be very, very careful about valuation of inventories. And they should be stated at the amount at which they are either realizable or cost, whichever the lower of both of them. Now, in many cases, what is happening that questions have also come through members that the assessee is not maintaining stock records. So how then the financial statements are finalized? Then how the valuation is done? And in certain cases, when the valuation is taken, they just have in the valuation sheet the items and the cost. But where is the comparison? Where is the NRV column? And then the comparison. Right. So when financial statements are prepared, ensure the professionals who are preparing it to compare it through that chart and the auditors to verify that. This might seem to be a very, very, I would say, simplistic thing. But yes, I'll request all those who are listening to put extra carefulness efforts on the valuation of inventories and accounting thereof, because all the stakeholders are very, I would say, looking after the professionals who are finalizing the financial statements and auditing it. So inventories is one of the major item out there.
Okay, thank you for your input, sir. Abhinay, sir, the next question is for you. Can the interest cost be added to the cost of inventories?
Yeah, so I think we had already have some discussion
Yeah, so the
on this
qualifying asset.
point.
Yes.
So, if I, just discuss this quickly. So, Yagnesh sir has already taken an example of
Right.
Muscle Dog, So in
Mhm.
those specific cases where the inventory meets the definition of qualifying asset under Ind AS 2, so interest cost has to be capitalized on that. And Ind AS 2, in conjunction with Ind AS 23 borrowing cost. So interest cost capitalization will happen in accordance with the borrowing cost. So, so that is the case. Apart from this, I have already talked about the financing component. So if there is any financing component involved, with the supplier, I have taken some additional, period to make the payments. So for that case, if I am, bearing some interest, so that interest cannot be, forming part of the inventory valuation. So, but yes, for the qualifying asset, if there is a specific interest cost incurred on those qualifying assets, that has to be capitalized.
Yagnesh, so you wanted to add something?
Rightly pointed out by you, Abhinav, that interest cost to be capitalized if it is a qualifying asset and pursuant to Ind AS 23. Here, I'd like to draw your attention that Ind AS 23, paragraph 6E says that up to what extent this cost to be capitalized. To the extent it is considered as an adjustment of exchange rate, this is kind of a statement given.
Yes.
And it says, वो statement पढ़े ना तो मैं challenge मारता हूँ सब कोई मुझे honestly भगवान की कसम खा के बोले कि he understood the concept because that is mentioned in such a manner that is difficult to understand. But here I must salute ASB, including past chairman and present chairman, that they have come out with the ASI 10. Accounting Standard Interpretation 10 is a guiding document for capitalizing the interest cost up to what extent when the funds have been borrowed in foreign exchange. Because when you borrow the funds in foreign exchange, you have one more cost beside the interest cost, and there's the exchange rate. So in a nutshell, your criteria of comparison should be, अगर मैंने ये functional currency में borrow किए होते, had I borrowed this money in the local market in the functional currency, how much interest cost I would incur? So up to that level only, sigma exchange rate and interest rate in foreign exchange should be capitalized. Beyond that, it should be expensed out. ये तो थोड़ी फ्लेवर दे दी इंड AS 23 की सर वहां पे हम विजिट करेंगे ये मेरे मन की बात कर रहे कि चलो कुछ भी बात कर लेते हैं
नहीं it was very yes sir Pramod sir please add.
One thing when we talk about borrowing cost, specific borrowing, general borrowing, in the case of inventories, actually it says that in case of inventories, it is not about general or specific borrowing. The main criteria for interest to be added into inventories is that it should take more than 12 months for the inventory to be completed. If it is less than 12 months, even if it is specific borrowing, it won't be added.
Okay.
So one has to be very, very careful.
Qualifying asset.
Qualifying asset.
Right.
And one question which has come from Sumit Chan, one of the participants, which I felt that it would be beneficial for all members, that how to arrive at NRV, the difference between market price and NRV. So what is to be reduced from market price to arrive at NRV? Yeah, is there requirement to get it valued from an independent valuer, registered valuer, or someone like that? What is to be done?
Should I answer?
Chairman sir, that's the NRV is an entity specific value. It depends on its own selling price. I may be selling a laptop for 1 lakh rupees. Others may be selling for 1,25,000. I'm not concerned with that because there I'm not applying Ind AS 113 for the fair one, level 1, level 2, level 3. Correct? So I'm applying my own thing. And one more thing, this I should mention that an entity for the closing inventory should take a clue or the cue from the
latest invoices.
Yes.
And that is considered to be an adjusting event.
Yes, very true.
I mean, before the finalization of the accounts, right?
That is the adjusting event. जबकि ये investment को नहीं applicable होता है. It's applicable to inventories only.
Very,
So they
very
can
rightly
take the
said.
clue from the latest billing after the financial year, but before the accounts are approved. तो ये एक मेरे ख्याल से कुछ सुराग है सर, जहाँ पे हमको मिलता है कि भाई आपको इस अमाउंट पे करना
Value पे
चाहिए.
करना चाहिए.
तो हाँ, because fair value is totally, it's from the market participants perspective.
Correct.
मैं तो देखता हूँ कि मैं 1 लाख में मेरा लैपटॉप बेच रहा हूँ, तो मेरे हिसाब से 1 लाख माइनस जो भी कॉस्ट वगैरह है, तो वही करूंगा, नॉट 1,25,000. अब सुनते हैं चेयरमैन साहब से.
Sir, in my view, a very, very layman language, I would say, the net realizable value is basically the selling price of that item less the cost incurred to make that sale. Cost incurred to make that sale. Suppose my cost of an item is 60,000, I'm selling at 1 lakh, but for making that sale, I'm paying certain commission or some selling expense of 5,000. So my NRV would be 95,000. So I have to compare 95,000 with 60,000.
Yes.
So friends, please take care. The difference between in traded goods, it could be the market price is equal to NRV, but in certain items where the cost is to be incurred to make that sale, that is to be reduced to arrive at the net realizable value.
Yes.
Right. Abhinay sir, you would like to add something?
One more thing I would like to add here. So suppose I have the 1,000 quantity in my stock as of 31st March, and out of that 1,000 quantity, for 500 quantities, I have already entered into a binding sale agreement with a buyer, say for rupees, say 400 per unit. But other items, I am in general selling, say at 350 per unit. Then for the purpose of inventory valuation, for those 500 quantities, that binding price 400 would be taken and minus the expenses if I need to compute the NRV. And for the remaining ones, 350 would be considered as the selling price minus the expenses to conclude that sale. So that is
a very specific example, but
so although the items are same in all, physical appearance, usage, or utility, but still the price would be different. Hence, the inventory valuation would be different for these two.
Right. Thank you for the example. Yagnesh, you were adding something?
No, fine.
Okay, fine. So moving on further, Yagnesh, this question is for you. In case of search or survey by tax authorities, where the stocks are found in excess and the entity surrenders the same, how is the same to be accounted in the books?
Was it meant for Mr. Girish Ahuja?
No, it's meant for you, sir. If you can just throw some light on it.
Light to मेरे यहाँ से ज़्यादा आ ही रही है, but I'm throwing more lights. Okay,
Yes, sir.
All right. So in the first place, and I will also draw your attention to the CARO 2020 requirement and also the additional regulatory information required by division 1, 2 and 3 of the. तो दोस्तों ये भी ध्यान रखिएगा आप, केवल एज 2 पे ध्यान मत केंद्रित कीजिए, because they know there also you need to mention that. But now coming to that, so basically what is the fact that they have paid for this, right? Correct. Naturally they are not paid by check. Correct. Naturally they may have paid by cash,
right?
So accounting entry, in my opinion, would be, in the first place, since they have surrendered this, they have to recognize this. Because if they make surrender and pay the taxes there, and even if they don't, if they don't bring this inventory in the books of account, I think they are making the stupidest ever mistake.
Correct.
So they should get it recognized inventory, okay, and then credit the undisclosed income account, which will go to your profit and loss account. You will pay tax for that.
Okay. Pramod, would you like to add something on this? Yeah, sorry. Please continue, sir.
No, very, very rightly said. It has to be a double entry and increase in stock. Increase in stock, of course, because if it is both debit and credit in my statement of profit loss, the net effect would be nil, but the effect would be coming from my increase in stock. Because now, as Yagnesh sir very rightly said, in my additional regulatory information and CARO both, they said in case SEC surrenders certain assets,
value, so income, whatever it may be.
Income, if you need it,
which were not disclosed, accounted earlier. Now whether they've been accounted or not. So now, unless it is specifically exempted like Vivase Vishwasak and all those things. So now they have to ensure that yes, it is properly accounted for. Merely paying taxes separately. Now the accounting issue is there. Now you cannot escape. You have to account for both debit and credit, unaccounted purchases, undisclosed income, and this entries have to be there in my book.
And then keep on fighting with GST people also. Of
course, that is a separate issue.
Right.
But as regards companies that is concerned, I think Caro in this too, one will take care of.
Correct. Okay, moving further. Abhinay sir, this question is for you. How are the stocks valued in case of real estate developers?
Okay, so as far as industry is concerned, there is no industry specific discussions or different measurement criteria prescribed within the standard. So standard is applicable on all the industries in the same manner, right? So for the real estate as well, whatever the cost they are incurring in bringing their inventories to their present condition and saleable condition and location, all those costs would form part of their inventory valuation. So as such, there is no difference treatment available within the standard. There might be different methods or cost formula which different industries can take. For example, a specific identification method is one of the method under inventory valuation, which is to be used only for those inventories which are not homogeneous in nature and they are heterogeneous in nature. So if real estate players are constructing different houses, incurring different types of layouts, different plans, different costs, so a specific identification method has to be used in that case for accumulating the cost for that specific project and measuring that unit at the reporting date. So that's the thing. And Yagnesh sir, if you want to add something from your experience.
Yeah. In case of real estate companies, mostly the builders, not the contractors. For builders, even land is considered to be a closing inventory. Many companies have reflected land as a closing inventory. At the same time, there is something called transfer of development rights. There is something called transfer of development rights, or maybe there is TDR, OB, and in some companies, I think it is, if I'm not mistaken, that's the DLF company, where they have reflected it is as a development rights. And some companies are reflecting even these also. But land is taken as a part of the inventory till such time. But then when the building is totally constructed, the all flats are ready, then it's subsumed into the finished goods.
Okay.
And it's taken from the inventory and it is subsumed or then part of the flats and all this, ready-made flats. The finished goods. Yeah. And that was done by the Oberoi Realty.
Oh, okay.
Yeah.
Good.
And just one point I would like to add here. So in few of the cases I have seen, where the real estate players have extended hand, and incurred additional cost in, getting the nearby roads constructed so that their projects, can be sold at some higher prices. So that was the idea behind, getting those costs incurred. So what they have done, they have tied up with the government, state governments or the central government as the case may be, and incurred some additional expenditure in constructing the nearby roads or, service lanes. So although that cost is not to be forming part of their inventory directly, but still the purpose of this cost was incurred, inflate the values of those inventories so that, transportation can be made easy nearby so that, people are willing to pay the higher prices. So with that intention, there is a EAC issued by the institute on this matter specifically, where they have specifically highlighted that this cost will be inventory.
Just wanted to add, very rightly said by both Abhinay sir and Yagnesh sir. For the real estate developers, there is no specific standard under Ind AS 115. Of course, it is for the revenue recognition, which talks about completed contract method, and in the rare case, it is percentage completion. Under AS, there is no specific standard. Under ICDS, there is no specific standard, but there is for the non-Ind AS entities, there is a guidance note issued by the ICI for the revenue recognition, but there is nothing on the stocks. So going by the basic context that any expenditure incurred to bring that to the point they are sellable. all expenses should be clubbed into that inventory. Take that
That's
basic.
the prime concept.
Just wanted to.
Right. Thank you for pointing that out. Yagnesh sir, next question is for you. What is the accounting treatment on conversion of capital asset into stock in trade and vice versa? And at what value it is to be recorded in the books on conversion?
Again, there is no specific guidance per se in ACE and in ACE 2.
Mhm.
But since we are following the cost method, correct, the transfer within the all these categories inter alia, maybe from cost capital to the stock in trade and stock in trade vice versa to the capital asset, it should be done at the carrying value only. You cannot say that, my closing stock is residential flats and my cost of construction is about, say, 20,000 rupees per square feet and I'm selling it for 50,000 per square feet. So I will be transferring it 50,000 per square feet to the capital asset. No, that cannot be done. From the book's perspective, the book counts. Convert the capital asset into the stock in trade, then subsection 2 of section 45 will be applicable of the IT Act. That is about the capital gains tax. And there they say that even section 50C will not be applicable for the market. The section 50C is a specific general rule and is a general application, general provision. There is a specific provision is that suppose I have a capital asset, so say my book value is 1 lakh. Market value may be 5 lakhs.
Okay.
But I'm converting into stock at 2 lakhs rupees. Or even if maybe I can convert it to the give it at the my partnership firm also as my capital. So that is at the book value I can do that. But then income tax, as far as accounting standard is it is no. I think it should be second case. But here I draw a very devastating provision of the Income Tax Act, and that is, I think, 28, 1, then Roman 6A, which say that it has to be done at the fair value. And many of the builder companies are doing that. The chief among them is the Kalpataru Industries. They are the developers, and they have converted their stocks into the capital asset because they started giving on the rentals. Of course, now from the Ind-AS perspective, they are calling it the investment property in their books of accounts. Correct? So they have converted their stock in trade into the capital asset. So here, I think 28 Roman 6A is the provision of the income tax asset, which one should keep in mind. And they say that when you've done this transfer, it should be done at the fair value. It should be done at the fair value. And even if it is just transferring from right hand to the left hand, but still, and the entity ends up paying the income tax. And it is considered as a profit, the difference between cost and the fair value. But from the accounting perspective, I think it should be done at cost, unless Chairman Sir has something else to add on or improve on my views.
No, Yagnesh sir, very, 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 very aptly pointed out the provisions of the income tax. And the main difference also you pointed out very, very importantly, that there is a difference in taxation at the time of conversion from capital asset to stock in trade and stock in trade to capital asset. And both sections different. Because in case of, let us take first case where the capital asset is converted into stock in trade, the capital gain thereof is paid
only when it's sold. Ultimately, it is sold. It is crystallized at the book value. It crystallizes at the book value. Itna capital gain aapko hua hai. But you have to pay. The liability arises, triggers when that stock is sold.
Right. Now here what happens, that when it is converted into stock in trade, it has to be done at the fair market value, which again comes to circle rate. Now what happens, it could be a immovable property, it could be a jewelry. It could be jewelry also for a jeweler. Now what happens in certain cases, because they say that, okay, I'll account for that at fair market value in the books on the date of conversion. So that my opening stock is there in the business, and then there is a difference, I'll make that gain and that capital gain. But in such a case, if it is done, then the auditor should qualify that the stocks are stated not at the carrying value, at the cost, but at the fair market value. Now the question comes at a different stage when my stock in trade is converted into capital asset, because the tax is to be paid at that time itself and not later on. Now, if the tax is paid at that time, again, my cost remains same. I should not change my accounting due to income tax. Accounting should remain at cost.
At cost.
If it is variant, qualify.
Because as rightly pointed out, so now I'm taking a different perspective, sir. That you are artificially increasing the price value of the asset.
Right, overstating it.
I'm dealing with myself. So it's not a faithful presentation quality of the financial statements.
Correct. Abhinay, you would like to add something to this?
No, as such, nothing. This has been already discussed in very detail.
Yeah, very elaborate discussion. Okay. Yagnesh sir, continuing with the questions. How is inventory valued at the time of dissolution of firm or an LLP? And how is the treatment different in ICDs?
All right. So you use the word dissolution. That means the firm will come to an end?
Yes.
So am I supposed to follow the accrual method or liquidated?
Well, you will tell us whether should we follow.
So I am not following them. If I continue, then it is in the firm. Normally, sometimes it happens that there are 4 partners, 2 retires and 2 being added, and they still call it firm dissolution, admission date, and all kind of things. In that case, you continue to measure at the same value, that at the same method, like the lower of the cost and the NRV. But I think when you're closing the firm down, it should be purely on the NRV basis, whereas standard is silent on that, but ICDS says that it should be measured at NRV. And I think we've debated on that ICDS has overruled. There are judgments that in such cases it should be measured at lower of cost or lower of cost or cost and the market value.
Yes, there are 4 judgments on this issue. And
these all have been overruled, sir.
Yes.
देखिए इंडिया में क्या दस्तूर है? The moment any judgment is in favor of the assessee, you will say that next budget you will find this is going to be overruled.
Okay.
Correct? Yes, sir.
Right.
But here, I want to draw your attention to one section and one rule of the income tax, which is subsection 4 of section 45. And read with rule B. I think this has been recently introduced in last budget or something like that. So whenever there is any partner is being retiring partner is being given either his capital by way of capital asset, anything, I think he's paid anything in excess of his capital, then rule 9B and section 45(4) of the income tax act will be applicable. And those say that again you have to measure at fair value and taxation. कहने का मतलब ये है कि पहले हम बिंदास डिसोल्यूशन करते थे, रिटायरमेंट करते थे एंड कुछ नहीं करते थे, राइट? बट अभी ये फंडा ऐसा है कि आपको यू हैव टू बी वेरी केयरफुल अबाउट इट. सो फार एज द पार्टनर इज पेड एज गुड एज द कैपिटल, नो इशू. बट ध्यान से देखिए जरा सर, मैं इनकम टैक्स मैं गिरीश आहूजा सर नहीं हूँ, बट इतना तो जरूर कहूंगा कि आई थिंक इट्स माई ड्यूटी टू ड्रॉ योर अटेंशन. एटलीस्ट मोटा मोटा आपको याद है कि भाई राकेश रोशन साहब कुछ बोल गए थे, ये 45(4)(9)B, देखते हैं क्या है उस चीज में, है ना?
Sir, just to add, it is section 9B, which talks about both capital assets and stock in trade. 45(4) talks only about the capital asset.
Hey, sir, no,
yes,
it's not rule 9. Yes, sorry, section, not rule. I said rule. I think
section 9.
Sorry.
So in the case of dissolution, it says it has to be at the fair market value, market price. Now the question comes, in case of dissolution, it is quite okay that it is a partnership firm. One partner continues it as a sole proprietor. So it would be his cost. In the accounting also he can do it. But the question stuck to my mind when past few days a question came to me in case of conversion of a firm into a company.
Okay.
Conversion of an LLP into company, both. So in that case, the firm is dissolved. The LLP is conversion. When the firm is dissolved and then it is taken at the fair market value, then my lot of other things could trigger. because the firm, there are exemptions given under Income Tax Act for such conversion if it is under Section 47, 13 and 13B. So in that case, there would be no capital gain tax on all these things. But ICDS says that in such case, stock in trade, because it's capital gain, not stock in trade. Stock in trade is not governed by 47. So one has to be very careful regarding stock in trade is still there at the time you are converting. Dissolution is fine, but converting again, that is a part of dissolution process. I welcome my younger brother, Abhay Chajedji, young and dynamic CCM from Bhopal.
Thank you so much.
My vice chair.
Thank you, Chairman.
So just wanted to say that, okay, please take care at the time of conversion on the stock in trade.
Very rightly pointed out, sir. Welcome, Abhay, sir. Abhinay, sir, the next question is for you. When is inventory?
Before going to next question, one more thing I would like to add. What Pramodji has explained very well. So in this case, Pramodji, there is a case as well. Judgment is also overruled by the ICDS on this topic itself. And, ICDS prevailed and said that even if the firm is dissolved and business is discontinued, in that case as well, NRV has to be used.
Okay. Thank you for the additional input. Abhinay sir, the question is, when is inventory charged as an expense to the profit and loss account?
So when the inventory is sold, then cost of goods sold is recognized. So very straight and simple answer. So if you are selling the inventory, then cost pertaining to that inventory has to be charged to the P&L. Number one situation. Number two situation, if inventory is lost, then that cost would be charging to the P&L. Number three situation, if the inventory has become obsolete and there is no recoverability at all, then it has to be charged to the P&L. So basically, in all these situations, cost will be part of the P&L or charged to the P&L.
And it has to be disclosed in these standards, in notes to accounts, that how much had been expensed out, including sometime. So the cost would be the cost of goods sold plus the write down and minus reversal of write down. So that is the sigma sum, the amount charged to the profit loss.
That is the part of disclosure.
Right.
Yeah, part of one needs to disclose it.
It's like a summary of all the situations that we've discussed before. So continuing further, Abhinay sir, which inventory ratios are important for measuring the financial performance of an entity? And also please specify the ideal values.
So inventory ratios, inventory turnover ratio is the widely used ratio by the investors or the analyst of the financial statements. Whenever any of the investor or analyst, analyzes manufacturing or trading company's balance sheet, the idea behind analysis of inventory is inventory turnover ratio. In how many days or with what frequency the company or the firm is, able to sell the inventory or rotate the inventory, basically. Higher the ratio, the better it is. So if the ratio is coming somewhere in the range of, say, 1 to 5, it is considered as low. It means the entity or the company is not able to sell their goods, at very good frequency. But between 5 to 10 is a very good ideal ratio. And the inventory turnover ratio is being computed by different people, using different formula. Some people divide the cost of goods sold divided by the opening and closing inventory average of the opening and closing inventory. And some people use sales divided by, opening and closing inventory average. But the correct formula is cost of goods sold, which is to be used. Yeah.
What is the, yes, sir. Yes, sir, please.
And again, I'm over influenced by additional regulatory information in the 1, 2 and 3. जो 11 standards ratio दिए है उसमें भी inventory का ratio शामिल है.
Yes.
So उसमें is it the cost of goods sold or the other part?
Yeah, cost of goods sold.
So I think we should
Possible,
use
sir.
that as a reference and compute it, because that will bring uniformity across,
Yeah.
Yes.
And the best thing is that for all 11 ratios you are calculating, you should give the formulas. So
Yes, yes.
there's always a clarity on the part of the readers.
I think it was important also that way the uniformity aspect can be achieved.
Yeah.
Okay. So, Yagnesh sir, this next question is for you. What are the
Here,
first...
one point.
Yes, sir.
We have to be very, very careful that what is the time to convert the raw material into finished product. Now, suppose it is 1 day, 2 day, and what you see that in the financial statement, say the turnover is 100 crores and the inventory is 80 crores. Why and how? What is the requirement? If it is converted, generated a finished product into 2 days, then why there is a requirement of a 10-month or 11-month or 8-month stocks? So one has to be very, very careful in understanding that inventory, because what happens that in case it becomes an NPA, the same day also inventories are zero.
Okay.
So the fraternity should be very, very careful in the inventories and seeing that, guiding them, okay, whether you are preparing the financial statements or auditing them. So seeing the inventory, the reorder levels and all other levels, here is a time where we should help them out. If it is an actual position, see that inventory levels are to a reasonable levels, not too much disproportionate. That's why this ratio, what Yagnesh sir and Abhinay sir has said, these ratios would guide why it is so huge, why it is so huge. So an important role to be played by all of the members out there.
And more so when you have to give an explanation when it is change in the ratio is more than 25% over the comparatives.
So that's like additional, they go one step ahead and do the comparison from previous year as well. So that is also...
And not only that, if the difference is more than 25%, then you need to give the reason and rationales for that.
Right. It's reported. Correct. Okay, Yagnesh sir, what are the first time challenges that an entity will face while transitioning from AS2 to Ind AS2?
चुनौती होती है जब there are difference in the accounting treatment.
True.
अब जब accounting difference ही नहीं है तो कैसे आएगा? At a very minute level, the difference between the interest, that which if you paid before the above the normal credit term, then interest should have been should not have been part of your interest, the inventory cost. यही एक difference जो मैं देख रहा हूँ कि between AS2 and IS2, अगर difference नहीं है तो फिर कुछ चुनौती नहीं. If difference है, then they have to do the accounting retrospectively.
Right.
Nonetheless, there is nothing said in Ind AS 101 about the inventory. Is that there is a specific exclusion or not? So if there is no specific exclusion or the exception or the exemption, then one is to account it retrospectively. But I doubt that anyone of us is following so closely. Okay, that interest paid, if you paid something for 15 months' time, in which effectively includes a kind of a financing arrangement, then one should remove the interest from that. Okay, which otherwise was capitalized, entity 7. That's the only difference which I could see. Otherwise, 7 except there is no other changes here.
Okay. Moving further, Abhinay sir, this question is for you. Please enlist different types of disclosures in the financial statements required to be given under AS2 and Ind AS2. I know we've covered few of them, but I think a summarized form would be helpful for our attendees. You're on mute, sir. Abhinay sir.
Abhinay, you're on mute, dear.
Yeah. So sure, Asta. So as the disclosure is, the backbone of all the IFRSs, IFRSs are, focusing to, make the users of the financial statements step into the shoes of the management and see how the company is performing. So, all the IFRSs are, stressing lots of disclosures. So, key disclosures prescribed by Ind AS2, first is accounting policies, whatever the accounting policy is adopted and which all cost formulas the company is using. then the carrying amount of inventories, and total and the class wise. So if there are different classes of inventory company is dealing with, so the class wise disclosure of the carrying amount of that inventory is to be made. Then carrying amount of inventories at fair value less cost to sell. If you remember, I have touched upon the topic of brokers and the commodity dealers. They are measuring their inventory outside the measurement criteria of Ind AS 2, and they measure at fair value less cost to sell. But disclosure requirements are still applying on those companies. So they also need to disclose how the fair value loss cost to sell has been arrived. Amount of inventories recognized as an expense during the period needs to be disclosed, which Yagnesh sir has already explained. Then write downs, reversals, the circumstances and events which led to those write downs and reversals during the period needs to be explained. And if there are any inventories which are pledged as security for any of the loans which you have taken from the banks or any other lenders, then those encumbrances needs to be disclosed. Which inventories are those which are pledged? So all in all, these are very qualitative disclosures as well as quantitative disclosures as required by the standard.
Yagnesh sir, would you like to add something?
That's fine. Disclosures that there should, it has to be disclosed in the notes to accounts. And both should we normally we recommend that you disclose at 2 points: A, the inventory schedule, and B, at the borrowing. Okay. The one which pertains to the borrowings.
Yes, Pramod sir.
Two of the very, very basic things into the disclosure, very, very basic. Specifically, I would like to say in the case of non-corporates, proprietorship partnerships, what we have seen is that in the financial statements, in the balance sheet, they say closing stock or inventories and a single amount. That is not correct. Because AS2 is applicable to them, the whole classification is to be given. Finished goods, raw material, work in progress, WIP, stores, whatever it is there. It cannot be a single item.
True.
And secondly, I would say in the case of another thing into this classification, I wanted to say, another item which is required, which is given in the disclosures, is the carrying amount of the inventories.
Right.
Now, to be very frank, this carrying amount we have been giving inadvertently, because when we show in the financial statements, the balance sheet, the classification and the amounts of the inventories, it is the carrying amount.
Right.
But one has to be very clear while complying with the ICTS, they also talks about the carrying amount. And in 3CD, there is no carrying amount as such. So when they have to refer the carrying amount, they have to refer to that schedule of inventory in the financial statement.
True.
A very small thing, but yes, we are all professionals, so we should understand what is asked and where it is. Just wanted to bring that into the knowledge.
Very important, because last year itself, the technical guidance for the financial statements of non-corporate entities, that categorization is specifically given. So for us professionals also, we then mandate through, this technical guidance that the organization has to make this kind of classification in the financial statements. So very rightly pointed. Okay, sir. Yagnesh sir, are there any exemptions given to small and medium companies regarding the compliance of AS2 and Ind AS 2?
क्या उम्मीद करते हो आंसर के? What are you expecting from me?
No, I'm just asking if there's any, way out for them.
I'm just getting some flavor. कुछ monotonous हो गया तो मैं बोला कुछ उत्तेजना लाते हैं इसमें.
ठीक है सर, ऐसे आपका.
I'll come to the answer, but break के बाद बताऊंगा आपको उससे पहले. Now the Companies Act, Accounting Standards Rules 2021 have been notified. Correct?
Right.
Chairman Sahab, this is not connected with inventories and all these, but bit inextricably connected with the disclosure and some kind of requirement in the notes to accounts. We have this. It should be the correct nomenclature should be as per read with Rule 3 of Companies Accounting Standard Rules 2021. हालांकि अभी तक मैं देख रहा हूँ till March 22 फाइनेंशियल स्टेटमेंट में वो 2009-16 as amended Rule 7 के जिक्र कर रहे हैं.
Very rightly said, sir.
ये people should take care of it. अब यहाँ पे in this rules they have defined small and medium companies, SMC, correct? And they have also specified that which standards are applicable to SMCs or not, correct? So there is absolutely no relaxation to any companies.
Okay.
I know आप चाहते हैं कि मैं एक कदम आगे जाऊं, एक कदम आगे बढ़ूं मैं.
Please, sir, please.
हेलो.
हाँ जी सर, बढ़िए.
अब बात करता हूं मैं एनसीए की, नॉन कॉर्पोरेट एंटिटीज की बात कर रहा हूं, क्योंकि चेयरमैन साहब ने हर नक्शे कदम पे पार्टनरशिप फर्म इनका जिक्र किया, राइट? तो एंड दैट इज ट्रू. आज देखो तो इंडिया की जो स्मॉल स्केल इंडस्ट्री, इसका योगदान काफी बड़ा है.
करेक्ट.
तो हमें इन सेक्टर को भी ध्यान रखना चाहिए कि व्हाट अबाउट द नॉन कॉर्पोरेट एंटिटीज, जहां पे 4 स्टेज की है, लेवल 1, लेवल 2, लेवल 3, लेवल 4, है ना सर? करेक्ट मी इफ आई एम मिस्टेकन, चेयरमैन सर. NC नॉन कॉर्पोरेट एंटिटीज, now there are 4 levels. All 4 levels they have to still apply AS2. कहने का मतलब there is absolutely no exemption, no relief from AS2. तो जैसे सर ने कहा, बहुत संभाल के कीजिए. केवल इन्वेंटरी लिखने से काम नहीं होगा, आपको पूरा विवरण देना है, डिस्क्रिप्शन देना है. ओके. सर एक बार बताऊं सर, ये जब हम इन ऑन प्रैक्टिकल नोट व्हेन वी गिव दिस ऑल दिस भाषण टू देम कि भाई आपको ऐसा करना है, तैसा करना है, तो वो ही बोलता है सर प्रॉफिट कितना है उसके हिसाब से इन्वेंटरी करो.
बात तो सही है सर. ठीक है. Now I would like to share the queries that have been raised by the attendees. So any of you can report on the same. So the first query is, please enlighten on the ICDS disclosures in 3CB where no inventory record is maintained by the SSC. बताइए.
ICDS में मैंने देखा है कि लोग टिक 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 कर देते हैं, नो. Very rarely they qualify this.
I agree.
Sometimes when it comes to the payments more than 20,000, now related to 20,000, now it is 10,000, they don't put any qualification. They don't put general qualifications also that accounting financial statement is a responsibility to management. हमारी responsibility क्या है, सब कुछ नहीं लिखते सर. तो मैं समझता हूँ कि then we should qualify that.
I agree. Abhinay sir, do you have any other opinion?
No. I agree.
No, here I would like to add. It is not about whether the entity is maintaining the stock records or not. If they're not maintaining stock records, then how the closing stock was arrived? Very, very important. If they say, no, it was just put like that, then the whole financial statements, how the auditor can say it is true and fair? The question will come on the auditor. It will come on the management. So some basis have to be there. And if I talk about ICDS is totally different. It is talking about the recognition measurement principles, what Yagnesh sir and Abhinay sir has talked about. There is no difference out there. The recognition, measurement, disclosure have to be like that only. But you may be talking about in 3CD, the clause, I suppose it is 38, something like that, where the quantitative details is to be given. So that is nowhere, nothing to do with the accounting system. No, there it is, whatever disclosure you want to, disclaimer you want to give, you can give. But how the stock was valued, it was on the basis of physical verification or whatever it has to be. If you're not conclusive on that, the management, the auditor, all would be in trouble. So please, the disclosures are very, very simple in my AS2. It is not talking about stock records at all. Stock records, it is there in my Caro.
Correct.
In Caro, it is there. In my income tax 3CD, the quantitative details are there. But of course, the recognition, measurement, disclosure, either relevant ICDS too, and then its disclosure requirements.
Next question is from CA Umesh Bhatt. What is the procedure for valuation of inventories in oil and gas sectors?
So, there is one case which I have practically dealt with. So in oil and gas sector, there are certain oil and gas components which are pushed into the pipelines, but they are never extracted and sold, and they are just maintained in those pipelines to, make the pressures available so that oil and gas can be transferred, right? Now the question arises, do I need to consider the whole of the oil and gas sitting in that pipeline as my inventory first? And or do I need to demarcate, say 25% is always retained and 75% can only be extracted at any point in time, then 75% should I consider for the inventory purposes. So, there has been a lot of debate happened on this topic, and, multiple committees have set multiple times to discuss this. And, thereafter, this topic has gone on agenda of IASB as well. And they have come up with certain discussion, but with no conclusion. And they have dropped this item from their agenda, stating that this item is not so important for them and they have other important matters to deal with. Hence, when they get time, they will pick up this again. So for the time being, this item had been dropped from their agenda. Apart from this, what they have said while dropping this item from the agenda, that there are two types or two categories in which we can classify. First is, if that 75% can or that 25% can never be extracted, then it ideally forms part of PP&E. It becomes in the nature of property, plant, and equipment, because that is stick to that pipe and can never be extracted. Hence, it forms part of that pipeline itself, and that has to be capitalized along with that PP&E. Okay. And if it can be extracted and sold, and because anyway you have to maintain 25%, but that is getting replaced every time, then that has to be forming part of the inventory, because you do not know which gas has been extracted or which oil has been extracted, right? So in that case, it will become part of the inventory. So accordingly, they need to be accounted for under the respective standards. Once you are concluded with this judgment, and this judgment, there is no crystal clear answer. They have said that management and auditors needs to deliberate this, understand the circumstances and situations, and come up with the conclusion. And whatever conclusion they have arrived to needs to be properly documented and disclosed in the financial statements.
Yagnesh sir, do you have something to add to this?
Absolutely correct. I know there's a lot of debate, and ultimately, even after doing a lot of rigmarole and deliberation and discussions, even ISAB say is Narova Kunjova. They could not come to a conclusion. And sometimes the oil level, they call it the base stock.
Correct.
But anyway, they didn't come to any conclusion about how it should be valued. जब ISAB ने हाथ ऊंचे कर दिए तो हमारे और आपकी क्या मतलब?
So we've reached the end of the session, and I know there were a lot of questions to be answered, but we're running out of time. So I would like to invite our Vice Chairman Abhay sir to give vote of thanks for today to our esteemed panelists.
Namaskar, Abhay ji.
Yes, sir.
Before Abhay ji says, I just one point to add. There is one question from the panelists, from the participants. Rajinder Kumar Kadaria ji, his question is, in case of closing stock, valuation difference due to NRV or cost, how to adjust the same in books of accounts and disclose in financial statements?
Sir, can you repeat the question, please? In case of, sorry, please.
In case of closing stock, valuation difference due to NRV or cost, how to adjust the same in the books of accounts and any disclose that the same.
Sir, it is automatically captured by way of a reduction of the in the closing into. At the most, if you really want to be, आपको सत्यवादी हरिश्चंद्र बनना है तो लिख दीजिए कि it has been write down to some extent here.
I think Abhinay sir,
and that will be captured in the amount recognized in the profit and loss account, because that is है ना, cost of material consumed less write down plus the reversal of write down. चेयरमैन साहब इजाजत देंगे मुझे एक बात कहने की प्लीज, जिसका आपने कहा था कि यज्ञेश जी आप ये जरूर you draw the attention because that is a very typical specific item. When हमने आपने कहा cost में purchase cost, ये conversion cost, other cost हमने किया, but I forgot to mention at that point of time that when the cash flow hedge is done, when the hedged item is inventory, when the company has done the hedge accounting and more so the cash flow hedge item is inventory, then when the hedge is over, when the payment, everything is done, any gain or loss should be adjusted in the non-financial items. And inventory being a non-financial item, तो ये भी एक प्लस और माइनस इन्वेंट्री में हो सकता है. और सर ने मुझे कहा, यज्ञेश भाई, इंडेक्स 109 बहुत कठिन है, तो आप पैराग्राफ समेत दीजिएगा नंबर. तो लिख लीजिए पैराग्राफ 6.5.11.
Thank you for the input, sir. Over to you.
One point regarding valuation of inventories of securities. AS2, Ind AS 2 is not applicable. But if I talk about AS 13,
yes,
it talks about my investments, short-term investments. And there is a footnote out there which says that inventories of securities should be treated as short-term investments. So they have to be recorded at lower of cost and NRV.
Sir, sixer मार दिया.
It has to be brought down to the animation.
Sixer मार दी, fantastic. यहाँ नहीं तो कहाँ? That's
Sir, the question fantastic. Question was कि वो कहाँ दे रखा है AS के अंदर?
13 में, 13 में.
Now 13 में. Now another point. ICDS talks about something different. It does it because in my AS it goes script wise. In my ICDS, it is bucket wise. So that adjustment would go separately. My books would go separately. So kindly take care of that. Kindly take care of that. Just wanted to add at the end. Over to my very dear brother Abhay Chajed.
Thank you, sir. Thank you so much. And you can also add younger, so I'll be more than happy.
The younger to sir hai hai. Younger and smart.
Thanks a lot. Thank you so much, Chairman. And of course, it's always an honor and privilege to listen to you. And of course, a special thanks to Yagnesh Bhai and Abhinay for, sparing their so important time, I would say, today for 2 hours continuously. Excellent discussion. Of course, I had another meeting, so couldn't join on time, but sorry for that. But I could see the questions, which was Asta actually was raising these questions, and I'm sure there would still be a lot of questions which the participants would like to ask, because this topic is so practical and so, I think, useful for every auditor to understand. Whether you talk about AS2, you talk about Ind AS2, or you talk about IAS2, it's all, every entity, wherever applicable, the auditors would like to have more clarification. And of course, I'm sure the methods, the measurements, the basis, valuations, the loss, theft, all those I'm sure would have been taken up by Yagnesh Bhai, Abhinay, and I could see for the half an hour, 45 minutes, wherever I could be part of this. So, and thanks to both of you, and of course the moderator Asta for being here today, and taking this session so well and taking up most of the questions. But still, I would certainly request the participants, if there are any questions which they would still like to ask to the panelists, you can send it to the ASB, and we'll certainly try to send it to them, and in turn we'll try to respond to those issues. And thanks to my chairman, and always been always guiding for whatever technical issues or practical issues. He's always been there and available for the participants to share his experience, to add value to to the performance during the audit, and for improving the quality in the audit. So thank you each one of you, and thank you participants for your time for this 2 hours. I'm sure each one of you must have got excellent learning and interaction among the panelists and through our chairman Pramodji. Thank you.
Thank you.
Thanks to all. Thank you.
Thank you.
To everyone.
Thank you, everyone.
Thank you.